Hi, this is Gerald Sorensen with the Twin Power Real Estate Team, and welcome back to the Cashflow Corner. So in previous videos, we talked about the several ways that properties make money, and one of them was depreciation. So what is depreciation and how do I break that out? How do I know how to figure it? Well, depreciation is a very simple formula, but let's just go through an example. So let's say you buy a house in Waterloo for $60,000. $60,000 is probably a pretty good rental property in Waterloo. If it's in nice shape, it's a good purchase. It probably has good cash flow. And what does it have for depreciation? How do you figure that? On a residential rental real estate, depreciation is broken out over a 27.5-year term. So you take your sales price, $60,000, and you break it out into things that are depreciable, things that are not depreciable. So the thing that is not depreciable on any real estate is land. So the land portion is what? Well, so one way to figure the land portion is you could look at the county records. On the county, it has a breakdown of land and property and then your total tax basis. So I have gone in and done some math on several of my properties I bought and looked at the percentage of land value versus the percentage of home value. So it typically comes out to between 15 and 22%. So to err a little bit on the safe side, I typically will figure 20% land value. So out of that $60,000 house, I will take $12,000 and earmark it toward land, which is non-depreciable. Then I'll take the other 80% of the expense of that home, $48,000 in this case, is depreciable. So $48,000 is divided out over a 27.5-year period because it is residential real estate, and you deduct it as an expense. It's on the tax form, line item expense depreciation. That total would be $1,745 for the year. So let's just say you had that house, that $60,000 house, and you had good cash flow. So you're making, let's say you averaged out over the year, you averaged about $250 a month in cash flow on that property. So that $250 a month is really $3,000 over the year. Well, we're now just allowed to depreciate $1,745 of that. Over half of your income is now just been depreciated out. So your real income on that property is $1,255. That's what you're being taxed on, even though you probably did make that $3,000 in cash. So that's depreciation in a nutshell. Like I say, commercial property has different depreciation rules, as well as the ability to bifurcate, which means you just break out commercial property into more aspects of items. So that's a quick nutshell. So Cashflow Corner, stay tuned for more great advice.